Since 1926, the American stock market has created about $35 trillion of wealth. 35 trillion. So the typical stock must be a winner. It isn't. 4 out of every 7 American stocks lost to a Treasury bill over their lifetime. The median stock's lifetime return is negative, and almost all of that 35 trillion came from roughly 4% of companies. Here's the story we all carry around. The market returns about 10% a year. A rising tide lifts all boats. Buy and hold, be patient, and time does the work. It's a good story, and at the level of the whole market, it's true. But listen to the assumption hiding inside it, that if the market drifts upward, then the typical company drifts upward too, that the average stock and the ordinary stock are roughly the same animal. That belief sits underneath every, "I'll just pick a few good companies I believe in." And it may be the most expensive misunderstanding in personal investing, because the average stock is not the typical stock. They are not even close. The reason is an asymmetry so simple it's easy to walk right past. A stock can only ever fall 100%. That's the flaw. It cannot take more from you than everything. But on the way up, there is no ceiling at all. A stock can rise 1,000%, 10,000, 100,000. So the shape of stock returns is not a bell curve. It isn't symmetric in the slightest. It's a fat, crowded pile of losers on the left, with a spike sitting right at minus 100%, total wipeout, and then a long, thin tail stretching away to the right, holding a handful of absolute monsters. And it's worth being precise about that word, lifetime. Stocks do not live forever. They get acquired, they get delisted, they go bankrupt. A lifetime return is measured from a company's very first day on the market to its very last, and for a great many of them, that last day is a wipeout, and in a shape like that, the average and the middle come apart completely. The mean gets hauled upward by the giants out in the tail. The median just sits there, quietly below zero. So when someone quotes you the average stock return, they're describing a number that almost no real stock ever earned. For a long time, that was intuition. Then a finance professor named Hendrik Bessembinder did the arithmetic and published it in the Journal of Financial Economics. He took every American common stock going back to 1926, about 25,300 companies, and asked one blunt question. How many of them actually beat a one-month Treasury bill? Not the market, not inflation, just cash, the safest, most boring asset there is. The answer? Fewer than half. Only about 43%. 4 out of every 7 stocks that have ever listed in America lost to a Treasury bill over their lifetime. And the median stock, the one right in the middle, ended with a negative lifetime return. When the data was later extended through 2023, the picture didn't soften at all. More than half of all American stocks finished with a negative compound lifetime return. Now here's the part that rearranges your brain. All that wealth, the $35 trillion, where did it actually come from? 1,092 companies, slightly more than 4%. That 4% accounts for the entire net wealth creation of the American stock market, and the other 96%, collectively, as a group, they matched Treasury bills. They added nothing. Zero. And you can squeeze it tighter still. Just 90 companies, about 1/3 of 1%, produced more than half of everything. This isn't an American quirk either. Across 64,000 stocks worldwide, the top 2.4% account for the entire $75 trillion of net global wealth creation. So what does that mean for you? It means stock picking is not the game you thought it was. It is not a game of avoiding the losers, because the losers are the norm. They're the majority. It's a game of not missing the monsters. And the odds are ugly. Reach into that jar at random, and you are more likely to pull out a stock that loses to cash than one that beats it. Miss the handful of giants, and you don't underperform by a little. You underperform by everything, which gives us the hardest, most mathematical argument there is for owning the entire market. An index fund cannot miss the 4% for the simple reason that it already owns the 4%. You don't have to find the needle, you just buy the haystack. And it's the same physics that runs venture capital, where a single enormous winner quietly pays for 100 dead startups. Power laws, not averages. And let's be precise about what this does not say. It does not say the stock market is a bad place to put your money. The market as a whole did magnificently. That is exactly where the $35 trillion came from. What the data says is narrower and stranger. The gains are wildly, brutally concentrated. The market is a fine bet. The average individual stock is a bad one. So the next time somebody quotes you the average return on a stock, remember what that average is hiding. The market is not a rising tide lifting all boats. It's a lottery where a tiny handful of tickets pay for absolutely everything, and the index fund just quietly buys every ticket.